Okay, it looks like we've got a quorum. So, good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Joao Martins joining from London, and then sitting next to me here in Madrid is Patricio Alvarez. I think anyone who's a regular on this call, you know both these faces. And we're going to have a little bit of a special conversation. If you happen to be based in Madrid, come and see Patricio and I in person tomorrow. We've got a roundtable focused on many things, but primarily intersection of AI and energy demand. We've got the former head of the Bank of Spain joining us as well. So I think we're just sort of entertainment for him, perhaps. But anyhow, and then tomorrow or Friday rather in London, for any of you in London, myself, Patricio, Joao, and a couple others from the team will be getting together for a roundtable there. So if you need details on any of that, shoot any one of us an IB and we'll make sure to get you looped into those conversations. Okay, so with that in mind, I think that folks are still unpacking a lot of things related to the election. A number of the kind of energy, utility, clean energy landscape type stocks have at least moved somewhat since Donald Trump won re-election, and also we now know that the not just the Senate but the House is also going to be Republican controlled. So, Patricio, we'll come to you first, but I also want to bring you into the conversation, Joe, and just give us your sense of, how to read the tea leaves. What does Trump mean for utilities, but also for gas? Because I think it might have some relevance for gas, particularly here in Europe.
Sure. I think that on the first point for European utilities, I think it's good to remind everyone that European utilities were pioneers in the development of renewable power assets here in Europe, and they were aiming to replicate that growth story in the U.S. So the U.S. Concentrates roughly 30% of European renewable capex. So obviously the news about the elections or the results have increased the risk of a repeal or a reversal of the tax credits contemplated in the Inflation Reduction Act. So I would say at face value, it's very much headline risk at the moment. Our policy analyst in the US, Nathan Dean, he thinks there's only a 10% chance that the Inflation Reduction Act could be fully repealed, which would be a worst case scenario, given that a lot of European companies are benefiting from these tax credits, mainly the production tax credits, which are roughly $26 per megawatt hour of emission-free output. So that's a little risk or limited risk of a full repeal, and that's mainly because a lot of that renewable growth, a lot of that on reshoring of the manufacturing capacity is happening in red states. And we've already seen evidence of senators from those states trying to talk to Washington and the White House and saying, please don't touch the Inflation Reduction Act because it's bringing back jobs. It is really, if you look at the manufacturing spending chart over the past 4 or 5 years, it really has skyrocketed in the U.S. So the growth is real, and I think repealing the Inflation Reduction Act would be like shooting yourself in the foot on that way, in that matter. But I think the devil is in the details as well. If you look at the different technologies of renewable power, I think offshore wind is perhaps a standout in terms of being exposed to federal permit moratoriums. President Donald Trump has the capacity of enacting executive orders without consulting anyone and passing them through fairly quickly, and that could threaten, moratoriums on federal permits. So, and that said, obviously, offshore wind in the U.S. has had a tough couple of years. The supply chains are very much in an early stage, and development costs are still very elevated. So, Donald Trump, perhaps not all bad news, I would say, for renewables, but perhaps offshore is an outlier.
Let me play devil's advocate a little bit here, because when I think when you do a rational analysis of the options, supply options for electricity, you probably are going to conclude that wind and solar are the cheapest electrons you can put on the grid. You can even do that analysis where you contemplate firming them with batteries or gas backup, and I think you would still sort of generally arrive at this idea that they're relatively low cost electrons, and that's without using subsidies. So I'm curious, do you think the IRA really matters, or does it slow things down a little bit, but do you still see continued investment? Kind of how do you parse it if the worst case scenario as you described it does come to fruition?
So I think one good way to view it is that the Inflation Reduction Act was not meant to be there forever. I think it's just sort of to get things started or to incentivize or accelerate renewable investments, but it wasn't supposed to be there. A lot of the production tax credits are going to expire through 2033. So in terms of the underlying demand for renewable power is still very much strong. And I can flag an example, for example, anecdotal evidence from a company that we cover, EDP, which is a large Portuguese renewable developer. They've been seeing great demand for their new wind and solar projects, demand that has driven up the offtake prices for their power price, for the long-term power price agreements. And they've been talking about prices of $60 to $70 per megawatt hour, which kind of roughly offsets the loss of that PTC, of that production tax credit, because levelized cost of electricity for renewables in the US is $30 to $45 per megawatt hour. So if you put the 26 on top of that, it lands you at around 70 to 75. And now we're seeing evidence that demand is already driving up prices for PPAs without the need of PTC. So I would agree with your characterization. It might slow things down, but I think that the wheels are in motion, and renewable power will continue to increase in the US.
Yeah, I want to come back to the idea on renewable demand here in a second, but Joao, let's bring you into the conversation. A number of the companies you look after, I believe they also have done this concept that Pat was just describing, talking about European-based companies investing in the US. So for the ones you look after, is this still an attractive market, even with the risk the IRA does get changed, modified, repealed, albeit a low one, or are you starting to see more sort of skittish feet already, or anything like that?
Yeah, I think I would echo most of what Patricio said. I think like he said, for most utilities, the US on the renewable segment represents 30 to 40% of investment. But for some of the renewable focused developers, that goes up to almost 50%. That's the case, for example, with EDPR, and almost that for RWE. Ørsted is also particularly exposed. And what we've seen in these recent earnings calls, actually already looking at policy risks, is that most companies have been very prudent in framing their growth prospects after the elections. Most of them reference the risk as being a tangible risk, and are looking at ways of potentially shuffling around investment if something actually changes on the policy, because for now we've not seen any evidence of that. Like Patricio said, the biggest risks are on offshore. It would be a big risk if tax credits were changed, but there's a lower chance of that happening. I think the third risk is on the tariffs, not directly impacting the renewable developers, but putting tariffs on the supply chains of these projects, whether it's for European suppliers or higher tariffs for Chinese suppliers, that would feed through to the cost of projects in 3 to 4 years. So projects that are being built now or will be built over the next 2 years are largely, all the materials are largely procured, and they shouldn't be impacted. But after that, prices might start to go up from the suppliers of these companies. So that's another risk. And I think companies are already looking into that, but they will take a wait and see approach to see what Donald Trump will actually do. And then, like Patricio said, the longer term demand fundamentals in the US are still very favorable, and especially compared to Europe. Like he said, we've seen comments from companies saying that they're already seeing higher demand for PPAs from tech companies and other players. There's also been Bloomberg NEF data that supports these, that PPA, the signing of PPA contracts has recovered already so far this year. So there's evidence that corporate interest might actually be able to partly offset any policy, any softening of the policy support. So I think companies remain positive. The US remains the biggest vector of growth outside of Europe for all of our players. And we expect that to continue.
Okay, thank you, Joao. We'll definitely come back to the tech angle here in a little bit because some of our colleagues have a very interesting new report out today that I think might be good fodder for this discussion. But before we move on to this idea that tech and AI and things like that could be driving demand for energy and power, I want to hit on a little bit deeper on the gas conversation. Mm-hmm. I believe it was either yesterday or day before. We just hit the I think the 1,000th day following Russia's invasion of Ukraine, and so this conflict has been going on for quite a while now. And when it first happened, the gas markets in Europe just really, I think, had difficulty kind of managing through the conflict, and we saw very elevated prices. We have seen some things. We've seen some normalization there, but one of the big pieces of, I think, the narrative in Europe is that the U.S. really became a dominant supplier of gas into Europe following the Russia's invasion of Ukraine, and so. What's your read on Trump and how he's thinking about LNG? Are LNG exports a good thing? Is this something he's going to be pushing for? I think there's less clarity on kind of where that goes. I haven't heard a whole lot of mention about it. I assume probably status quo might exist, but what's your read? Is there potentially any change under Trump? Is there an acceleration of that idea under Trump? And what does it really mean for Europe? Depending on how it goes.
Sure. So I think one a good place to start is where we are now after those 1,000 days of the conflict. It's Europe lost roughly 40% of its supply, almost 40% of its supply that used to come from piped gas from Gazprom. At the moment, Europe only receives roughly 10% of its supply from Russian piped gas, and that has caused some volatility as of late in terms of prices, because there's been speculation that those residual flows via Ukraine will cease soon, probably by the end of this year, which will tighten the balance by about 5% into next year. We've also had a colder than expected, or a colder winter start than the previous two winters. So storage withdrawals are much higher than they were this time last year. So just for context, storage is roughly 92% at the moment. Last year at this time, it was almost 99% full. So everything looks like pointing towards the storage levels that are going to be lower this year at the end of winter, which means that the reinjection gap for next summer will be larger. And that's what's keeping gas prices a bit higher or tighter at 47 euros per megawatt hour. In terms of what Trump could mean, I think in the near term, so we're talking about perhaps 2025, 2026, I don't think Trump can do much to shift the landscape. But if that deregulatory platform that he's been campaigning on, right, like he's been trying to or saying that he will deregulate the energy sector and try to just like push for this mantra of drill baby drill. If that applies to not only oil but also gas, and and all those the regulation for LNG supply gets relaxed, I think our general sense is that over the next 4 to 5 years, LNG supply from the US will actually increase at a much faster pace. What that means, I guess, if you compare LNG to Russian piped gas, LNG is roughly 2 times more expensive. So I guess it's not great for us in the short term, but over the medium term, if supply from LNG from the US increases, the global market balance is due to flip into oversupply relatively soon. That said, that means that Henry Hub prices in the US, if they expand supply too fast, those very cheap gas prices in the US might start converging to the LNG export prices for us. And I guess President Donald Trump won't like that either. So all that said is that in general, higher global supply of LNG is good for us, because I think even if there's a peace agreement between Ukraine and Russia, I think Europe will not be in a rush to procure piped gas from Russia at the same levels as it used to do, and particularly because Nord Stream 1 and 2 are still out of commission. So those are the 2 main pipelines.
Yeah, that's where my mind was going. You know, if Trump does succeed at settling the conflict, is something he's spoken pretty openly about wanting to do. I am curious there are minimal gas pipeline flows now, and it used to be 40%. Yeah. So could it possibly go back to 20%? What's a scenario? I mean, or are European policymakers just going to continue to want to pump the brake? I mean, because it seems like a political question rather than a pure economic one.
I mean, I think that's the $1 million question, right? Because it's hard to know if we look at a negotiation, like from a negotiation standpoint, if the U.S. brokers a peace deal, the U.S. doesn't have, I would say, the interest of letting Russia supply gas back into Europe again. I think that's the conflict of economic interest. So yeah, I think that would be my main answer, is like there's no interest from the US to get a peace deal done if they're going to lose that market share from LNG. So yeah, it's I don't have a full answer for you there, but I think that will be the things to consider.
Joao, on the fact that Patricio mentioned gas prices being a little bit more elevated headed into this winter season. How does that work for most of the European power players? Is this just a cost pass through? Does higher gas prices help the companies that are geared towards renewables, or do they just have fixed contracts for all the renewables, so the gas price being higher doesn't help them? You tell me. I'm curious.
Yeah. So it does help. So most renewable developers have contracted or hedged something between 70 to 80% of their revenue. So you still have about 20 to 30 that can be exposed to spot prices, and obviously higher gas prices are reflected in Europe into higher power prices, because it is the source that sets the marginal cost for power. And so we've seen throughout the year that power prices have recovered from lows in Q1, in 1Q, and they're now stabilized, and that has been reflected into the earnings outlook for renewable developers. So we've seen recently, well, just to set the context, these companies the earnings of these companies are declining, in some cases meaningfully versus 2023 and certainly versus 2022, because either way power prices have eased significantly. But throughout the year, what we've seen is that a recovery in power prices has helped stabilize the outlook. In some cases, most companies do expect to meet their earnings guidance for the year, which was into question after 1Q, because prices were so low. In Spain, for example, prices, and even during the summer, prices became negative at points, and that really clouded the profit outlook. Now we do expect most of them to meet their guidance, but longer term, there's still uncertainty, because first of all, gas prices might also come down again. Like Patricio said, the fundamentals longer term are a bit different I think in the near term, we're very focused on the supply risks and the potential price upside. But longer term, the demand fundamentals are really not there for European gas. And so there might be at some point, and like you said, there's a potential oversupply of LNG that might cause prices to come down. And so that would be reflected in power prices. So longer term, there's still a lot of uncertainty into how much prices will fall in Europe. Forwards imply mostly a normalization of prices versus pre-war, pre-Russia-Ukraine war levels. And that would mean that there's still downside for power producers that are exposed, more exposed to merchant sales. And those would include companies like Acciona, RWE as well on their thermal front. And I think Patricio can add anything on that.
Okay, fantastic. Thank you. I think with some of the remaining time, one of the things that may be worth pivoting to is this idea of the intersection of AI and energy demand. We've worked on this topic a fair amount for some time now, and I'll just flag that our colleague Mandeep Singh and everyone who works for him have put out a new deep dive report today. So you can find that by hitting BI Deep Go on your terminal. And just the headline number here is that they think that by 2032, the generative AI market will be about 1.6 trillion a year in revenue. And so to have all of that occur, that implies a lot of CapEx that's going to happen, and all the data centers that are going to support this build out have to procure energy, and energy is really potentially one of the constraints for the industry. I think they're going to solve all those constraints and be able to build the things that they need to build, but it is going to require the power companies, anyone who can supply electrons, to move at a pace that they're perhaps not accustomed to. It's all kinds of questions revolving around nuclear related to it, but also wind, solar, gas, I think are all pretty well positioned to have exposure to this interesting theme. So Patricio, I want to get your reaction to the latest numbers from Mandeep, because the last time they had done this exercise, it was 1.1 trillion. So they've found an extra $500 billion in annual market size that they think is going to exist, which we're going to have to go back and update our numbers. But this is a pretty interesting new report, and it's very detailed. And I think they've been on top of this issue, and they've been right in the right places so far. So get your reaction. Does this mean even energy's got more potential demand upside as a result of this?
I think so. I mean, yeah, looking at the headline number, just you're adding 500 billion, almost in the same time frame as the previous report, which I think ran to 2030. So if anything, it just I would say reinforces the view that the deployment of AI in data centers is going to stoke power demand, mainly in the US. I mean, that's your wheelhouse more than mine, but we think that the epicenter of this growth will be in the US. I mean, I showed you a chart about power demand earlier that shows that power demand in the US, if you take a 2008 baseline, it has increased already by roughly 5% since then, while it's done the opposite in Europe. I think since the financial crisis, the correlation between GDP growth and power demand, especially in Europe, has completely delinked. And you can argue that that has to do with industry offshoring. So manufacturing capacity in Europe has been in a similar level of decline. So that kind of explains why. So that's why we think most of the growth will be in the US. And as you mentioned, this sales number implies that capital spending would need to go up by about 40% per year. I mean, at least that was the previous report. So I'm assuming this one implies even faster growth. And given the pace of expansion, I think the main thesis doesn't change. I think solar and batteries, given their shorter lead times, lower capital costs, and more mature supply chains, because a lot of those module makers and manufacturers are already based in the US now. I think that those will be the technologies poised to accelerate faster. There's also opportunities for I would say onshore wind more than offshore, but I'm still, I think the jury's still out on offshore wind. We still need to see what happens. But there will be opportunities for demand growth for those technologies. And the other one that I think is important to flag is in the US, natural gas demand is also increasing. So if you look at the trajectory for power demand and gas demand in the US, it's very similar. They're both to the upside. They've both been growing in the past 5 years or so. In Europe, we've been doing the opposite. And I would say for the European chapter of AI, roughly 15% of global data center market share is hosted in Europe. Europe has many regulations, and some of them mandate that because of data security laws, that data that is going to be used by AI for inference models and large language models, those need to be hosted in the EU. So there could be a case made that will drive up demand for data centers here in Europe. And we've already seen a few of our peer group, let's say Iberdrola and Solaria and those type of renewable, like the renewable side of their utilities already gearing for that growth. We've seen ambitious plans to turn Spain into sort of a hub. And I think some of those theses, like parts of the thesis do work. What do you think about when you think about AI demand and power demand? Lower power prices or cheaper power prices. Spain has some of the cheapest ones. Land availability. Spain is, I would say, relatively underpopulated compared to other countries. You could argue against because of cooling needs. Spain is not an exceptionally cool country, but that brings up the case for the Nordics. So there is some opportunity for higher power demand in Europe, but I don't think it would be strong enough to change the overall direction of energy demand in Europe, which has been roughly flat to declining over the past 2 decades.
Let me ask a hypothetical question. I want to get both of you to sort of weigh in on this, but some of the data centers that we're seeing get developed are approaching gigawatt scale. And when I say gigawatt scale, that means they consume, a gigawatt of power. And so that's why you've seen so much conversation around nuclear, I think. But are there markets in Europe right now where you can go to either the local utility or an IPP in that market and say, hey, I want to connect a 1 gigawatt new source of demand, and how long will they get laughed at? Are there markets where that's possible? I mean, even let's say you're even willing to pay a premium for the price because you want to get it done. How's that conversation going to go when you start knocking on the doors?
I don't think it's going to go great here in Europe. And that's, I would say, from a practical standpoint, or just how the market is designed. Nuclear makes part of this like shrinking baseload power supply in Europe. So baseload are plants, type of plants that you need to run 24/7 because of the intermittency of wind and solar, etc. So gas, hydro, and nuclear. Given that nuclear is already in scarce supply in Europe because we've been shuttering plants instead of building them over the past 2 decades or so, if you were to try and connect a nuclear plant from directly into a data center, you'd be taking away from that baseload, supply, which means that power prices in that region or in that distribution zone would need to go up to cope with the intermittency of wind and solar and a higher call on gas to make up for that loss in nuclear. So I don't think regulators would be too inclined to allow rates to go higher, especially since, like Joao mentioned, power prices in Europe are already elevated. They have come down from their records in 2022, but German power prices are still 90 to 95 euros per megawatt hour, which, if you compare them to the prices in the United States, are still 2 to 3 times as many jurisdictions there. So I would say the appetite is low. If you want me to pivot and talk about like what happened with the 3 Mile Island case, which is I would say that's different because that plant was mothballed and the plan is to bring it back after it's been already shuttered. I would say that something like that happening in Europe still would face a lot of political scrutiny. It's hard to say if it's possible, but I would say that's more possible than connecting or redirecting power from existing plants.
Did Germany actually demolish all their old nuclear power plants? So there's no hope of them ever coming back at this point.
There is so companies like E.ON and RWE, I think they still have like residual capacity. If you look at their books for 2024, they still have a couple hundred megawatts of reserve capacity, but they used to have 2 to 3 gigawatts each. Since they decommissioned or started decommissioning them since 2022, I would say there's some potential chance of reversing at least those shutterings partially.
Mm-hmm.
So I would say my answer is yes. Yeah, you could see some revival there, but again, I think the politics in Europe just don't work that way.
Joao, curious because I know you look after some of the companies that are sort of quite active in developing renewables. If you're a data center type customer and you come and you say, hey, I want to build a data center, I want to power it with clean energy, clean electrons, or at least mostly with clean electrons, what kind of answer are they going to get from your companies? How quickly can they move? Do they have availability now to help meet some of these kinds of incremental demand loads that companies seem to be talking about?
Yeah, so not at the speed that these companies would wish for. Most of the renewable developers, they're building already their projects for the next 1 to 1.5 years. If you're coming now with a new project, you're probably and looking at maybe the fastest technology to build, so solar, you're probably still gonna have to wait 1.5 to 2 years to have it built. And then you need to think about the grid connection. Can you build it in a place where there's already enough grid connections to support that or not? If not, then there's a huge backlog to build grids. And that's the next step that we're looking at in Europe. How can we build the networks fast enough to support all of this growth? And that's where things are even more uncertain, where policy support is growing, but it's still more nascent versus supporting renewable development. And so the power sector is very unlikely to meet the speed that these tech companies wish for in building their data centers, even on the renewable side.
Okay, very interesting. I know we're a little bit over. There's one more topic I wanted to just quickly ping you guys on, and I know it's more of a U.S. topic, but a little bit of noise earlier this week. Governor Greg Abbott in Texas put out I think his administration basically did a white paper, but they talked up the idea of Texas trying to accelerate nuclear, all kinds of new nuclear in the state. And so I think we're seeing a lot of conversations like that in the US. My skeptical hat take would just be still that nuclear has a lot of hurdles, probably going to take a while, even in states and in markets that want to be supportive. So, I still think whether it's conventional nuclear, some of the newer technology like SMRs coming onto the market, this is just not a technology where you can sprint. But if you flip it over here to Europe, is anybody even pushing that conversation? Where do SMRs fit into the mix? And I know Europe tends to have much more sort of broad proclamations of where energy markets should be going than we do in America. But is there a voice for nuclear within that conversation?
Yes, there is for sure. That said, Europe, is composed of several countries, and there is a divergence, I would say, in sort of the direction that the energy policies take across different countries in Europe. I would say strong nuclear power proponents or supporters are the UK, France, the Czech Republic, The Nordics, Sweden as well, Finland. Those are the countries that are still looking into building not only new traditional type reactors or renewing their fleets, but they've also been putting putting money where their mouths are in terms of putting together funds to try and put themselves in this race for the new generation of nuclear, where you're looking at new ways of cooling. I think cooling is one of the main issues with traditional nuclear, because you need a fresh water source 24/7. So that complicates the whole engineering part of it. They're looking into alternative ways of cooling, and companies that are within that space are EDF, Westinghouse. You also see Rolls-Royce is sort of in the short list of projects in the UK. So the UK already has set up a regulatory body outside of Ofgem that looks strictly or just directly into pilot projects for new SMRs and new types of technologies. Something very similar is happening in France. And that said, regulators know nuclear takes time. And I think most consensus expectations for some sort of commercial development is not expected until the mid-2030s. So nuclear could play a role, I would say, until maybe if you look all the way out to 2050. But if you look out into 2030, 2035, nuclear is not going to move the needle in Europe.
All right, cool. We do have one question from the chat, so I'll pose it to both of you, and I think it's just basically, will natural disasters that are you could classify as climate-related natural disasters, hurricanes, increased flooding, have any impact on U.S. energy policy? I personally think that we kind of have a pretty good sense of the trajectory of where the Trump administration is probably going to be on these kinds of matters. So I think we're probably not going to see. We might see a little bit more support for nuclear. I think some of the wind and solar support may survive. We've been talking for a while that full IRA repeal is unlikely, but some of the ITC, PTC could get weakened or phased out more quickly as part of general tax reform discussions. But maybe just to hear from, we'll come to you first, Joao. I think that the sort of conversation in Europe is quite different. And I know there's been heat waves, flooding, all kinds of things in Europe over the past 12, 24 months that maybe feeds into the conversation. Are European lawmakers talking about trying to speed up the energy transition process as a result of sort of observed phenomena or not?
I think in Europe, policies is really set in stone, and renewables is the way to go for policymakers. It's been like that for a while. We're phasing out coal. Germany, I believe, has to phase out all of its coal by 2038. But for example, RWE, which is one of the largest utilities, is aiming to do it by 2030. That is not going to change. And I think any issues, any catastrophes in the near term are not really going to change, because we are already on path to just add renewables. Like Patricio said, nuclear kind of depends on the country, but it's not really a growth vector for the energy mix. And so no, in Europe, I don't think it poses significant changes, at least for now. These issues are also less common than in the US. So the way we see it in Europe, policy said renewables is the way to go, and that should continue.
Okay, we'll give you last word, Patricio.
Yeah, I don't have much to add to what Joao said. I think European policymakers do have it in the best interest to deploy renewables, and that's not only because they like them and it's the cheapest form of energy or whatever. I think it's mainly because Europe is not resource rich. We are a net importer of gas. We are a net importer of oil. Our fossil fuel reserves are declining. So it makes sense for policymakers to incentivize the adoption of renewables. Obviously, from the standpoint of climate, it's also a no-brainer. We need to accelerate the energy transition here in Europe. And the only thing I have to add on top of what Joao said is now the focus is on grids. So investing in modernizing and expanding grids. I think that's sort of the fastest or the most solid part of our peer group, I would say, is companies that are investing heavily in grids. In for example, in Enel's latest earnings call, we saw, or sorry, strategy update, they did their triennial capital spending plan recently, and for the first time we note this mention of higher spend, not only for growth but for maintenance and for resilience. And in resilience is where you contain all the provisions for disasters, for wildfires, for storms, for these type of events that have become more common. In Europe, I would say they're not. I don't know if they're worse or not than in the US, but in Europe we've seen a couple of disasters lately that will require higher spending in grid. So it's kind of, I would say, Europe, if you look at the energy transition as a timeline, Europe is a bit ahead of the US in that time frame, because like Joao said, we've done a lot in decommissioning coal. We've replaced it with either gas or wind and solar, and now it's coming to the point where renewable markets are too competitive because power prices are low, because interest rates are high. And if you look at the energy mix in Europe, it's much cleaner than the US already. So now it becomes of what, like a matter of what's the next growth investment is powering up grids, expanding grids, local distribution zones to interconnect the new renewable capacity, and bringing power from resource, like from where the weather produces good load factors to places where you don't have that availability of renewables.
Very interesting. Well, I think to me, hearing you say that, I feel like we need to have a deeper conversation at some point on this call, looking not just at that sort of grid resilience, grid investment issue, but perhaps storage as well. And we can take an agnostic approach, perhaps look at hydrogen and battery storage and just get an update on that, because for anyone in the power market space, I know that's been a hot topic here lately. But we've gone well over our time. Most of you have stuck with us, so thank you for that. I'll just reiterate, Patricio and I and some of our colleagues have a great event in Madrid tomorrow. We got an event on Friday in London. Please say hello to us in person whenever you can. I mean, even if you just want to meet any one of us on the call for a coffee, come into a Bloomberg office. We're always happy to do that. So we don't want to just be faces on your screen. We're happy to say hello in person at your convenience. So look forward to being in touch. And even though it's U.S. Thanksgiving next week, I think we are going to hold the call next week. Maybe we'll have a little bit more European folks calling in for that one, given the U.S. holiday. But join us next Wednesday at 10 a.m. New York, 3 p.m. London for a continued conversation. Take care, everyone. Cheers.